There was a time, not long ago, when a lot of deals worked. On paper, they looked clean, the returns looked attractive, the leverage felt efficient. And buyers walked away from closings believing they had made disciplined decisions. But something subtle was happening underneath all of that. The deals weren't always strong, the environment was. Because when the cost of capital is low, the math becomes forgiving. And when the math is forgiving, weakness hides, until it doesn't. Cheap debt doesn't just lower payments, it creates the illusion of discipline. A buyer can pay a higher multiple, and still show acceptable returns. They can take on more leverage, and still maintain coverage ratios. They can accept thinner margins, and still feel protected. And over time, that starts to feel normal. But here's the problem. If your deal only works because the financing is unusually favorable, then you didn't buy a great business. You bought a structure that depends on a condition you don't control. And that distinction doesn't matter, until the condition changes. Cheap debt was doing something very specific. It was compressing the cost of risk. When borrowing is inexpensive, you can justify higher purchase prices because your required cash flow to service that debt is lower. You can stretch on valuation because the payment still fits. You can rely on refinancing because the market feels stable. And most importantly, you can tolerate mistakes. That's the part that gets overlooked. Cheap debt gives you room to be wrong. Wrong on growth, wrong on costs, wrong on integration, wrong on timing, and still survive. But when that disappears, you don't just lose upside, you lose margin for error. When rates rise, something very mechanical happens. The payment increases, that's obvious. But the second-order effect is what actually matters. The buffer disappears. That gap between what the business produces and what the structure demands gets smaller. And when that gap gets small enough, the entire deal changes character. It goes from stable to fragile. And here's the part most people underestimate. It doesn't feel gradual, it feels sudden. Because once the buffer is gone, every normal business fluctuation becomes amplified. A slow month is no longer manageable. A delayed payment becomes a problem. An unexpected expense becomes a decision. And suddenly, you're not operating for growth anymore, you're operating for survival. There are certain types of deals that were always more exposed than they appeared. High multiple deals. When you pay aggressively for a business, you are implicitly assuming stability and growth. Cheap debt makes that assumption feel safer than it is. But once financing tightens, the premium you paid becomes pressure. Thin margin businesses. If the business does not produce strong free cash flow relative to its size, it has less ability to absorb shocks. Rising debt costs don't just reduce returns, they compete directly with operational needs. Aggressively structured deals. High leverage can work when conditions are stable, but leverage is not neutral. It amplifies outcomes, and when the cost of that leverage increases, the amplification turns against you. And then there's a category that deserves special attention. Deals that relied on expected improvement, not actual performance, but projected optimization. These are deals where the buyer says, "We'll fix pricing, we'll improve operations, we'll grow revenue." And those improvements are used to justify the structure. Cheap debt gives you time to figure that out. Expensive debt doesn't. One of the most dangerous effects of cheap debt is psychological. It teaches the wrong lessons. A buyer who closes a deal and sees it perform under easy conditions may believe their underwriting was strong. A sponsor who executes one or two deals successfully may start to believe they have a repeatable edge. And those beliefs compound. They take on more risk. They move faster. They trust projections more. Not because they're careless, but because the environment rewarded them. Then the environment shifts, and suddenly, the same behaviors produce different results. This is where a lot of operators get caught off guard, because they're not adjusting to a new market. They're still operating based on lessons from the old one. In a higher rate environment, the game changes in a very specific way. Deals have to stand on their own, not on financing, not on projections, not on future refinancing assumptions, but on actual, present, durable cash flow. And that forces a shift in how serious buyers think. They underwrite more conservatively, they assume less growth, they model higher costs, they leave more room in the structure. And most importantly, they walk away more often, because discipline becomes visible in what you don't buy, not just what you do. Strong operators focus on a different set of priorities. Durability. Is this business stable enough to handle stress without breaking? Cash flow quality. Is the income consistent, or does it depend on too many variables? Control. Do I understand the levers of this business well enough to respond if things change? Optionality. If conditions tighten further, what are my moves? These are not exciting questions, but they are the ones that determine survival. Because when cheap debt disappears, you don't get rewarded for optimism. You get rewarded for resilience. What we're seeing now is not just pressure, it's a reset. Weak structures are being exposed, overpriced deals are being questioned, capital is becoming more selective. And for disciplined buyers, that's not a disadvantage, it's an opening, because when the market stops supporting weak deals, strong deals become easier to see, and strong operators stand out faster. The deals that stop working overnight were never really working on their own, they were working because the environment allowed them to. And now that environment is gone, so what's left? Real businesses, real cash flow, real operators, and real discipline. And that's where the next generation of acquisition entrepreneurs will be defined. I'll see you in the next one.